risk is a notoriously difficult thing to define for a lot of different people and what it really means. And to be able to look at an investment and say, was this risky or not? And even if the investment was successful in the long run, you still can't determine, was that actually very risky? And for you guys, what's interesting there is, that you're not going to be getting the top dollar returns that you could elsewhere, but you're achieving good solid returns and still mitigating the downside. And that's huge. It's something that's hard to quantify, but it's what separates the really good long-term investors, the Warren Buffetts, the Howard Marks of the world, from the people who, fly by the seat of their pants, get really close to the sun, their wings melt, and they crash back to the ground.
Mm-hmm. Yeah, I think I used to get really frustrated by this, and it took me a little while to understand, because when we raise money from investors, and 80% of investors, when they get a book, they flip right to the returns page and they want to see what it is. They don't look at any of the assumptions. They don't look at the capital stack. I mean, we could spend a whole episode on what you need to look for. And I used to get really frustrated. And I said, there's got to be a way to come up with another number to be like, hey, here's the risk and here's the reward, and you can balance it out. The problem I've realized is risk is very subjective. Return is not really subjective at all, I would say. Maybe it is, but I put in X amount of dollars. It took so long and I got X back, and there's formulas to figure it out. Risk is, what's the risk for investing in New York versus Charlotte? Well, it really depends on the individual. Some people may prefer Charlotte. Some people may prefer New York. You're going to put a different weight on that. The year it was built, 1960s versus 2010, how much weight do you put on that? How much risk, like how much do you care about that? And that's really what the risk comes back to, of what are you doing? If you're a 18-year-old kid versus a 75-year-old grown up, you're going to look at it differently too. Like, your risk profile is going to be different. So, there's a lot of things for figuring out, like discount rates, but because everybody's risk profile is different, almost everybody has to weigh it up themselves. So it's still frustrating, because I think there's a lot of people that invest passively or are looking to get into the space that I think are undereducated as they make decisions. But I think at the end of the day, as long as the person putting the money in understands that there is a very real, possible, and probable outcome that you lose all of that money if you do it yourself and you leverage, possibly owe money, then I think you have to be comfortable with that person's decision, looking for the upside.
I agree fully. I would say, for our listeners, I want to throw out a resource that could help you try to understand what Chris is talking about, the subjective nature of risk, but how important it is, because it's really hard to quantify.
Yeah.
Howard Marks, really famous investor, Oak Tree Capital. You go to his website, you can download a memo called Risk. I think it's back from 2007. And it lays out very clearly why risk is such a subjective thing and how it can differ between different investors. And it is a bit of a moving target. And Chris, like with our current deal that we've been doing over these past 2 months, we had the same experience with investors. They would go straight to the returns and they would say, well, this says 15% IRR over here. This guy's doing 17. And we're like, well, yeah, but these are fundamentally different deals with different risk profiles. But it's really hard to quantify that and give them a number and say, on a scale of 1 to 100, this is only a 5 in risk, or this is a 50 in risk. And so it's hard to get people to, to really understand that.
Yeah, the best we've been able to do is kind of like what you said, is point them to the assumptions. If we look at the cap rate assumptions, which is a big one, what are these other guys planning on doing? Do they have a refi factored into their projections? Do they anticipate organic rent growth in the future? Are they using these assumptions that they used back in 2019 today? Because if they are, then there's a lot of risk that is not reflected there that they're exposed to. But a lot of people don't look at that stuff, unfortunately.
Yeah, it's one of the things I'm seeing right now, and not to cut you off, but
no, that's fine.
More and more people
I'm used to it with
Dan. Do preferred equity in syndications.
Yeah, I've seen
a lot of people. I would imagine a lot of, we'll call them retail investors or passive investors, who aren't in the space, maybe not as educated, just looking for passive investments, probably don't have a great understanding of what it means and how it actually impacts the returns. I'm not saying the syndicators or the people raising the money are doing it to amplify returns, because that is part of it.
But it does.
But I don't think people I don't think people understand. Well, I think they're doing it, one, because I think there is a demand for it. I mean, I think
Mhm.
some of the terms on preferred equity, especially with the way things are going, I actually think is very attractive from a risk reward standpoint. Like, we've
Yeah.
seriously considered putting together a preferred equity fund, raising from investors to go out and actually place with other operators, because we feel that the terms that are kind of out there in the market, risk reward is actually pretty favorable from, the downside to the, you're capped on upside a little bit, or
Yeah.
you are capped, but that kind of risk reward felt good to us. And the way we kind of just saw the market and returns and cap rates, all that stuff. But I also think the person that is not investing in the preferred equity and is investing just in the common equity limited partner space oftentimes probably doesn't have the full grasp of how the difference in the projections can affect their returns,
Hmm.
and how much it can actually amplify the difference of how much your returns move, both
Up and
negative
down.
and positive,
Yeah.
right? They have upsides and downsides. It's the same thing as adding on extra debt. Preferred equity is really just a debt piece.
Yeah.
Mhm.
It
But
used
it's
to
ahead of
almost,
those LPs on the capital stack. I think
yeah,
that's what, to your point, I don't think people realize, like, hey, this is like another loan and it's ahead of you.
yeah.
So there's
It
what
was
is,
almost, I think it's just, I think the difference is just in like it's more technical. Like, you don't have I don't think you can put like a lien on the property or anything. I don't really
Mm.
fully understand the technical side of it, but from a layman's term, it's almost the same as what people will call mezzanine debt,
Mhm.
which is really almost like a second position debt, because they're going to get their capital out first. They're going to get their return first, but it's just going to be capped at a certain rate, which is higher than the first position loan. And it's typically anywhere from 8 to 12%. And some of it's paid every month, some of it's accrued on sale. There's a
Mhm.
lot of different ways to structure it. But yeah, I don't
Yeah.
think that I think a lot of retail investors don't understand it. And again, they just flip to the return, look what
Yeah.
they're looking for, and decide, do I like this property? Do I like this person? And do I like the returns?
Yeah, well, I think
Mhm.
with, like, as just debt in general is a great tool when used properly. So
Mhm.
I don't think anyone listening to this should shy away from deals that have a preferred equity component. I think it's a
100%.
great tool, but it's definitely worth understanding exactly, to Chris's point, um, where you stand in line, I
Mhm.
guess, when things get paid out,
Yeah.
because there is technically, some other people ahead of you there. And that's not necessarily bad, but it is something to look at and be like, okay, is this a preferred equity stack combined with overly rosy assumptions? There might be, a little bit of error in this deal. So
Yeah. And, taking a step back too, I have no idea what the conversations look like between the people investing in the common equity and the person running the deal. For
yeah,
all I
we've
know, they
never
do an
done it
absolutely
personally.
fantastic job of explaining it to that person. I'm just from the outside looking in, and just, I would bet more often than not, they don't have the full understanding. Just having these
Yeah.
conversations all the time, and what people's expectations are, and
So
how much
can
time
we
they're
can,
willing to spend to really understand.
can we make this tactical for our listeners who
Sure.
maybe aren't familiar with the preferred equity concept, and they maybe see it in a deal? Because in the last month, I would say I've seen 5 or 6 deals
It's
from
on
other
every
operators come
deal.
across my table. Every deal now has preferred
Mhm.
equity.
Mhm.
What are the 3 things, or however many things, we should be looking for, or questions they should be asking of their operator? And maybe this is outside of our purview, seeing as how, Dan and I, we haven't done preferred equity split yet, and I'm not sure if you guys have, but it might be interesting if we can break this down a bit, and so they can walk away with something tangible.
Mhm. Yeah, I think a few things when you're looking at it, you need to understand. The first thing you should look at is, what percentage of the purchase price and the total cost does the debt and the preferred equity add up to?
Mhm.
Is
Mm.
it, is the debt 60% of purchase and the preferred equity is 80%? Or is it the debt is 70% and the preferred equity is 95%? Those are two very different things. I would say the first one's way more healthy than the second one, but it also depends, you got to look at it on total cost, right? If it's 95% of purchase, but it's 65% of total cost because they're doing a lot of renovations and it requires a lot of capex, and they didn't want to take out a bridge loan, you might feel better about that. So
Mhm.
understanding the total capital stack, which is, the debt, all the capital. So all the money coming in, and what does it make up, and what are the relationships? So is it, is it debt and what type of debt? Is it preferred equity? Is it mezzanine debt? Is it common equity? How much are the general partners putting in? Everybody, you should understand where every single dollar is coming from and what position it's in, no matter if there's preferred equity or not, but with preferred equity especially. The second thing I think people should know is, how is that preferred equity being paid? Is it on an annualized or an IRR basis? With the IRR basis, it gets compounded every month. So that means over time, they're going to be taking slightly more and more, which probably won't throw it off. But again, just good to know. Is it paid every month so it comes out of cash flow, or does part of it accrue upon sale? So sometimes what you'll see is like a straight 9 or 10% pay. So that means if you put in $100,000 and it was 10%, you're going to get 10,000 every single year, usually paid every month or quarter. You can do the math. I'm not the best at it. Or what they'll do is they'll take a portion of the preferred equity return and they'll accrue it until a refinance or a sale. So it might be 8% pay every month, quarter, year, and then another 2 to 4%, maybe even 6% is accrued. So it's not paid until that deal sells in 3, 5, 7 years. It still comes before the common equity return, but it's not paid until sale. So it's just understanding that relationship, I think, is super important going into it.